In this video, we're going to work through a sim for absorption and variable costing. So before we look at all of the information, we're going to scroll down and see what it is that we need to calculate. In this problem, it wants us to calculate the manufacturing cost per unit for both absorption and variable costing, the ending inventory at the end of the month, January 31st, for both methods, the gross profit or contribution margin for both methods, and the operating income for the month for both methods. Okay, so I know essentially I'm going to have to do all of the calculations related to the calculating of cost of goods sold, calculating the income statement, calculating the ending inventory. So I'm going to go ahead and go through and do those calculations and then match up my answers to these questions. So if I scroll back up, I'll just start reading information, and the first thing that we're going to do is we're going to calculate the cost of goods sold. So I've got two columns set up already here for variable and absorption costing. And remember, for cost of goods sold for variable, the only things you're going to include are the variable costs associated with manufacturing. You won't include any fixed costs associated with manufacturing or any variable costs associated with the selling and administrative, which would be period cost. So if you remember, there are four main cost types: fixed and variable product cost, also called manufacturing cost, and fixed and variable period costs, also often referred to as selling and administrative costs. Variable only uses one of those four types. It uses the variable manufacturing or product cost. Absorption costing, when we're calculating the cost per unit, is going to use fixed and variable product costs. Okay, so period costs always get expensed immediately. All right, so variable, we're going to use variable manufacturing costs, also known as period costs. And under absorption costing, we're going to use the same, but we're also going to use fixed manufacturing costs. So I'm actually going to drop this down because I believe the problem separates things out by type. So if we go and take a look at the problem, we have an email here, and it says, January was a very good month in the production department. By producing 50,000 units, we surpassed the monthly goal by approximately 10%. We also achieved our other goals of matching actual unit cost with the standard unit manufacturing cost of $6 for direct materials and $1 for variable overhead. Barring no breakdowns of equipment, we should be able to reach or surpass our goals for this month as well. So what they're trying to tell us there is that they have standard costs and that they were able to meet their standard costs. So the $6, $10, and $1 represent regular cost, and we expect that to have been the cost in the past, and we can expect it to be the cost in the future, basically, is what they are trying to get out here. So when we come back over to my spreadsheet, we've got variable manufacturing costs, and we have direct materials, direct labor, and variable overhead. So we're going to call that manufacturing overhead variable. Okay. So I'm going to make my column just a little bit bigger here. Okay, and I'm going to set up 3 columns. I'm going to drop this down. I'm going to set up one for a per unit amount, which is what this gives us. It said direct materials were 6, direct labor was 10, and variable overhead was 1. And then I'm going to take my number of units, and I'm going to get to my total. And we said that they made 50,000 units during the period. So my total would be the amount per unit times the number of units. Okay. And these things are going to be identical in absorption costing. So instead of reformatting over here, I'm just going to copy and paste. There we go. And I also know for my absorption costing, I'm going to have fixed manufacturing costs. Well, I know direct materials and direct labor are always variable, and I know I've already got my variable manufacturing overhead listed, so the only thing left that could be a fixed manufacturing cost would be manufacturing overhead that is fixed. So I'm going to replace that line with manufacturing overhead fixed so things look a little bit more uniform. And if I go back to my problem, we'll keep scrolling through here and see what we can find. Looks like we have a trial balance, and it gives us our sales in total dollars, and it gives us our total manufacturing overhead. Well, from there, I can find my fixed. So if I go back over to my spreadsheet, I know my total is 150 for manufacturing overhead, and I've calculated my variable at 50. That must mean I have $100,000 left for the fixed. So now we have all of the costs that are going to be included in our inventoriable costs, the costs that get assigned to inventory and then spread over the units to determine the cost of each unit. So we're going to call these inventoriable costs, and we're going to add them up. Okay, and then if we want to calculate the cost per unit, we'll divide it by the number of units that we manufactured during the period, and the problem said that was 50,000. And that gives us our costs per unit. And I am going to take this one out and look at it to the nearest cent, just so I know what I'm calculating here. And when I do this over here for absorption costing, it divides the 950,000 instead of 850,000 by the 50,000 units and gives us a cost per unit of 19. Okay, and then I'm going to draw a line, and I'm going to come down here and do my income statement. So for variable costs, we do a contribution margin format income statement. For absorption costing, we do a straightforward regular financial statement for the income statement. But both of them are going to start with sales. So we put our sales line in, then we go back and look at our sales again. It says we sold 51,000 units, which was $1,530. And then we're going to subtract out our cost of goods sold, which represents variable manufacturing costs only. And remember, those are also known as your variable product costs. And so the problem says that we actually sold 51,000 units. We manufactured 50, but we sold 51. So we're going to take 51,000 and multiply it by our cost per unit. And I know you're probably thinking, well, we only produced 50,000 at this cost. But if we go back to that email where it talks about it being our standard cost, we know that that's the regular recurring cost. That's what they're trying to imply there. So that's why we multiply it by 51,000. And we assume that the cost per unit every period is 17,000 if they're hitting their goal. And then we need to consider what kind of an income statement we're doing. And so for variable costing, they will do a contribution margin format income statement. And remember, contribution margin format takes the sales and subtracts out all of the variable costs. Well, we've just accounted for the variable manufacturing or product costs, but we also have to subtract out the variable selling and administrative or period costs. Okay, so if we go back over to our problem, it tells us in this trial balance what those are. Variable selling and administrative costs are $50,000. So then we have a contribution margin after subtracting out all of our variable costs of $613,000. Now we have accounted for our variable product costs and our variable period costs, and on a contribution margin format income statement, we have to turn around now and subtract out our fixed costs. And we have fixed costs from product and period categories. And so I guess actually if we went with the wording on this problem, it would be fixed manufacturing cost. And then we'll have fixed selling and administrative. And if we go back to our problem, we can find those. So fixed selling and administrative costs were $200,000. And we've already calculated our fixed manufacturing costs over here when we did our cost of goods sold for absorption, right? We were given our total manufacturing overhead, and we had calculated our variable. So what was remaining had to be the fixed, which was that $100,000. So I'm going to pull that $100,000 over here that we've already calculated. And we should have operating income of our contribution margin minus our various fixed costs, $313,000. I'm going to draw a line there. Okay, now I'm going to do the income statement for the absorption costing, and it's going to start with the same sales. But remember, when you're doing absorption costing, you're going to do just a regular old income statement that you're used to doing for financial reporting purposes. And so this is going to subtract out your cost of goods sold, and your cost of goods sold includes your fixed and variable product costs, which are all encompassed up here in our cost per unit. So I'm going to subtract out cost of goods sold. Oops. Okay. And we sold 51,000 units times the cost per unit, 19,000. And that is then going to give me, I'm going to drop down here one line so that I can keep everything kind of roughly even. Let me come back up here. And that is going to give me a gross margin of $561,000. From there, I will subtract out my selling and administrative costs that represent From there, I'll subtract out my selling and administrative cost, representing my period costs. Okay, so I'm going to have variable, selling and administrative, and I'm going to have fixed, selling and administrative. And so we already know the fixed selling and administrative cost. We had those over there, so we're just going to pull those here. And then the variable selling and administrative costs are given to us here. It says they're $50,000. So we'll plug that in. And my operating income is going to be my gross margin minus my variable selling and administrative minus my fixed selling and administrative, $311,000. And then finally, I need to calculate ending inventory for each. So I can get to ending inventory by taking my beginning inventory and adding to it anything that I added to the total inventory during the period. So we'll just call those additions. And then subtracting out anything that I sold. And that will give me my ending inventory. Since everything has been measured in units for us, we're going to do it in units, and then we're going to multiply that by the cost per unit. So the beginning inventory we can find if we go to our balance sheet from the end of last period. Because you remember what you end one period with, you begin the next period with. So as of December 31st, year 6, or January 1st, year 7, we had inventory of 5,000 units. And it said that we manufactured 50,000 units this period, and we sold 51,000 units. So that must mean that we have ending inventory of 4,000. And then I'm just going to multiply that by my cost per unit. I'm going to pull that down from up here. And that will give me my ending inventory. Okay, so for variable costing, my ending inventory is 68,000. I can just copy and paste that over here into my absorption, right? Because the number of units won't change. And when I copy and paste the formula, it's going to move over and pull down my cost per unit for absorption, 19. So my ending inventory for absorption costing is 76,000. All right, well, I've gone through and calculated everything I'm going to need. Let's go back to the problem and answer the specific questions. So it says the January manufacturing cost per unit. For absorption costing, that's 19. And for variable costing, that's 17. And then for my January 31st inventory, that's what I just calculated down here. Absorption, it was 76,000. Variable, it was 68,000. My January gross profit or contribution margin. So my gross profit, same thing as my gross margin, 561,000. And that's for absorption. For variable, my contribution margin was 613,000. And then it asks for my January operating income. Under absorption costing, it was $311,000. Under variable costing, it was $313,000. Please let me know if you have any questions about this video.